What's going on, everybody? It's your boy Sal in the building. Thank you for joining me. I'm back with this amazing presentation about options. I've been getting so much commentary about, teaching people about options, and I did some research last night, looked at what trading videos they have out there on it. You guys are absolutely right. The videos that are out there right now on options are absolutely horrible. So I hope you guys appreciate this training on options, intro level training, by the way, in my voice. Okay, so let's move on. Welcome. For those of you guys who don't know me, just look around my YouTube page, press like, leave a comment on something that you want to see in part 2 of this video. If you're new here, click subscribe. Donate if you like what you see. You felt you learned something by the end of this video. Show a little bit of respect to your boy and donate $1 or $2. I'd definitely appreciate that. Twitter, if you'd like to get in contact me, is the best way to contact me at Free Stock Pick. Also, if you'd like to email me at happypennystocks@gmail.com. All right. So let's go ahead and get started. Why trade options? Well, options offer you the ability to have incredible leveraging power. All right. Incredible leveraging power. For those of you who don't like the idea of trading over-the-counter stocks, you don't like the idea of trading companies you've never even heard of, or companies with sketchy, past histories or products and services, but you still want the opportunity to have the incredible rates of return that many over-the-counter stocks achieve, you can get that by trading options. All right. Options allow you to be able to have a stake in some of the most popular and most expensive stocks on the market today by putting up very, very little risk. In fact, I have this example on the screen, USO, which is an ETF, and USO trades or follows the commodity crude oil prices. Now, USO is currently trading at $9.59, which is a 12-month low for the stock. Now, if you felt that by April of next year, USO or oil and the commodity called oil, crude oil, is going to be up and doing a lot better. If you wanted to take a stake in USO right now, straight common stock, you'd have to buy, you don't have to, but let's say you wanted to buy 100 shares. That 100 shares would cost you $959 right now. Now, if you don't want to do that, but still want to be able to play the potential of USO turning around by April of 2018, you can buy an option, or the April 18th, 2018 call option at $15. Let's say you think it's going to, rise another $2 or $3 by January, by March. You can buy that April option today for only 7 cents. That's what it's going for right now as I make this video. So with that option, you control 100 shares for only $7. For only $7. So you've saved yourself $952 of less risk to control the same amount of shares. That is the power of options. All right. The same quality, setup with very much less risk up front. Now, what is an option? An option is a contract. They're contracts that grant the right but not the obligation to buy or sell an underlying asset at a set price on or before a certain date. Now, I just gave you that example about that option in April. So an option doesn't require you to follow through on that. So if you get to April and it's not anywhere near $15, or the option has actually gone down, you could have easily had sold out of that option before that time, or weeks. You can sell out the very next day you buy, even though that option gives you the right to exercise it months, maybe even a year away. So options don't, obligate you to anything. You are simply buying the right to follow through on something. Options are derivative securities. So a derivative is a security with a price that is dependent upon or derived for one or more underlying assets. And we're going to talk about that in the very next slide. Exchange traded funds or common stocks make up options. All right. So an exchange traded fund is a marketable security that tracks a basket of assets. So We just talked about how, options are derivative securities. If you buy an option in an exchange traded fund like SPY, tracks the S&P 500. So when you buy the SPY, you get, the opportunity to participate in stocks like Caterpillar and Chesapeake Oil and many other industrial S&P companies. So Exxon Oil and many of those other great, very familiar stocks, BP and many of those stocks that you know and love. And what's great about buying options in exchange traded funds is that you remove yourself of the risks that comes with common stock. For example, an exchange traded fund can never all entirety go out of business. It could never come out and say, we, fraudulently, fix the books or something like that. So exchange traded funds allow you to be able to participate in a sector or in a country, or there are many different exchange traded funds that allow you the opportunity to participate in several different baskets of assets. A common stock, as we all know, is a type of security that signifies ownership in a corporation and represents a claim on part of the corporation's assets or earnings. So common stocks the most popular ones do have options available on them, and you really want to stick to popular or heavily traded common stock. We'll talk about that a little bit later on why. But here are some opportunities. Bank of America, Caterpillar, Apple, Amazon, they all are common stock that have options available for you if you, for whatever reason, can't afford to buy the stock outright, or just want to be able to have the right to exercise the opportunity to buy or sell stock in those companies in the future. Now, you got to understand that a contract or an option contract, a standard contract, includes 100 shares. There are minis out there that offer you 10 or whatnot. Just avoid those. Focus on standard contracts that include 100 shares. So if the option is costing you 14 cents, for example, you multiply that 14 cents by $100, and that option is therefore $14. That 14 cents times $100, and that cost is $14. So for $14, you have the right to purchase 100 shares and exercise that at a time and price in the future. Now, what is that $14 called? That $14 does have a name, and that is called the premium. And the premium is the payment that you paid to give you the right to have access to that contract. All right. So cost of the contract times 100 shares equals the premium. And in the previous example, that $14 is your premium. The strike price. The strike price is the agreed upon price to buy or sell an option. I want to show you an option chain, and along with the several different strike prices that are available for you to buy options at. Now, options come in different forms. There are weeklies, there are monthlies, as well as leap options. Weeklies expire, as it says here, every 8 days. They come out every Thursday, and they expire 8 days later on Friday, with adjustments for holidays. And investors enjoy 52 expirations per year. All right, so weekly, monthly, and leap options are available for you to trade. So this right here, ladies and gentlemen, is called an option chain. And this is an option chain for a stock called ExxonMobil company. You must be familiar, I'm sure you're familiar with that company. And as you can see and look on this option chain here, you can see here that these options expire every 7 days. All right, every 7 days. Now, all the weekly options haven't been released yet. So as you can see here, the September 8th or 9th one is missing, so that one hasn't came out yet. So as these are expired, they're replaced with the new option that will be created. All right, so as you can see here, this July 14th option expired today. This July 14th expired today. So you'll see a new Exxon option come out later in the chain sometime next week, Thursday, right? But after that, everybody's going to be buying or before that, everybody's going to be buying that July 21st next week, Monday. All eyes are going to be on July 21st as this one will be gone. All right. And playing weeklies has a very, very dangerous part, and that's called time decay. All right. That is probably the most dangerous thing about playing weekly options in the week that they expire. Time decay is the ratio of change in an option's price to the decrease in time to expiration. Since options are wasting assets, their value declines over time. As an option approaches its expiration date without being in the money, its time value declines, right? Its time value declines because the probability of the option being profitable or in the money is reduced. So that's the very danger you bring upon yourself if you buy out of the money options in the week that they expire. All right, in the week that they expire. And we're going to explain all that very, very soon. Delta is another very important aspect of trading options you have to understand. The delta is a ratio comparing the change in the price of an asset to the corresponding change in the price of its derivative. For example, if a stock option has a delta of 65, right, 0.65, that means if the underlying stock were to increase by $1 per share, the option on it will rise by 65 cents per share, all right, with all else being equal. All right, so for example, I have a stock that costs $1, right? I bought an option on it for 1 cent. If that stock, right, if that stock goes to $2 and my delta is 0.65, that means that 1 cent option will go to 66 cents as soon as that stock goes to $2. That's an incredible amount of profit. That's an incredible amount of profit. All right, potential in trading options. So let's go back to an option chain, and I want to show you, this is another broker tasty trade. I want to show you guys different kind of option chains that are available out there, because you're going to see different brokers have different looking option chains, but they're pretty much all the same, where you're going to see the calls on the left side, puts on the right side. All right, in the money for calls is going to be going up. Puts in the money is always typically going to be going down. All right, going to be going down on that right side. Some are going to have them highlighted, some aren't. I'm going to show you one that's highlighted. I'm going to show you one that's not. As this one is not highlighted, but as you can see, some brokers have just a simple line, and that line saying that everything above this marker is in the money, right? That means if you were to exercise these options today, you would be in profit. And that is why you can see the deltas on these are very, very high, right? In the money call options are very, very high delta. And as you can see here, low delta options are out of the money, right? So AMD, the semiconductor stock, is trading at $13.88. This is a $15 strike price option, right? This is out of the money. So if you were to buy this option, you would lose money. So you wouldn't actually exercise this because why? It's below its current market price. So therefore, it has a very low delta because the market understands that, hey, today is July 14th. The chances of this stock going above $15 is practically, zero. So therefore, there is, no opportunity for you to make any real money trading, this stock's at expiration at this high of a strike price. Okay, so as you can see here, as we get closer to the money, price, or again, the stock is trading at $13.88 or below the money, we get very high deltas. Why? Because it's in the money. If we exercise this option right now, we are going to be in profit. If the stock continues to go up, we are going to be in profit because we are in the price, in the stock, deep in the money. All right. Let's keep it moving. And ladies and gentlemen, don't hesitate to rewind and go back if you don't understand something. All right. Now, trading options, the most important thing to understand is also the spread. All right. That's why liquidity is so important. But you want to buy stocks that have very tight spreads, right? Here is a very popular company, Sprint. Sprint is very popular. There's nobody who's an adult in America who doesn't know what Sprint is. But as you can see here, here's the bid and ask on the calls. And this stock is currently at $8.55 as I record this video. And here we have the $8.50 call option, but yet look, very little volume because look at this spread. These are very unpopular options for this stock. This is a huge spread. You're almost 46 cents difference between the bid and the ask. Those are horrible options to buy. All right. But let's say you said, Sal, I just want to get into the stock. I love Sprint. I just want it. So you hit the ask because you want to get in so badly, right? So you hit the ask for $1. All right. You hit the ask for $1 on this option. Now that's a horrible way to get into that because for where you are, there's a 46-cent difference between the bid and the ask. All right. So if you want to see how far this stock has to go for you to actually make some money, all you've got to do is take the delta and divide it by the spread. All right. You want to be as close as you guys remember when we talked about delta being 0 to 1 on calls. You want to be as close to 1 as possible. Now, if you divide the math on this, right, because you decided you just wanted so bad to be in this stock, all right, you wanted to be so bad into this option, you took the 55 delta, right, divided by that spread difference, and here you have $1.19. So this stock in Sprint has to go up $1.19 for you to make any money. That's not where you want to be. You want to be to as close to or below 1 as possible. All right. That means you've got a very good, well-priced option if you are below 1. If you are below 1. This doesn't make sense. This doesn't make sense for you to buy at, a time frame that is very close to expiration. Now, as you can see here, this is September, which isn't too far. So maybe at this price, you might say, well, I don't know, today's July, we might have a chance to go $1.19. All right. So you may still end up buying this, but there are better options for you out there. And I wouldn't buy something this far out as a consideration, especially a stock that's already in the money and having to go this far for you to make some change. On the other hand, let's look at a very liquid stock. All right. We just showed you the AMD example. And let's look at that again. AMD here sitting at $13.88. All right. In the money option, we're looking at the $13 option. All right. For just an example, the difference in the spread was only a penny. All right. The difference in the spread is only a penny. So all we have to do, divide that high delta, right? We got in the money option, high delta divided by the spread. So we're at 99. Perfect. That's exactly where we want to be. That's exactly where we want to be when we're talking about buying options that are close to expiration. All right. That's exactly where we want to be. Even, stocks that are out of the money, you want to get as close to 1 as possible, because the further you are away from 1, the more that stock has to do something in order for you to make money. Now, with that being said, if you believe a stock is going to crash, right, you might go out and get an option that's $20 down or $30 away because you just feel that, that stock is going to make the move either up or down to that price. So don't be deterred. Now, what kind of options do you want to buy after we've just done talking about deltas? Here are some opportunities for you here. So weeklies, you want to buy weekly options that have deltas of 80 or above. All right, of 80 or above. Actually, let's put that 80. There you go. Of 80 or above. All right, when we talk about weeklies, I wouldn't even look at any weekly below 80. All right, short term, something that is less than 30 days, you want something that's at least 60 or above. All right, at least 60 or above. 30 to 90 days. All right, 30 to 90 days. I want, if you're going especially 90 days out, 50 or above is fine. All right, 50 or above is fine. 90 days or more, you won't mind having a delta that's at 30, probably even lower than that. I've seen people buy 20 deltas if they feel that, again, that stock has the potential, or that ETF has the potential to go to that strike price, whatever it is. Obviously, if you're buying a delta that's 10 or 15 or 5 or something, that you're way out of the money, but you feel confident that that stock or that ETF is going to make that move in that direction. All right. So again, you're risking a lot of your capital. You better be buying deltas that are very high so you can be making sure you're in a profit as soon as possible. All right. You want to put some space on yourself and lower your risk, your time decay. You're going out 90 days or more, then you don't mind having a delta that's a little bit lower. All right, that's a little bit lower. But you've got to be mindful that you're watching those charts to make sure that that stock is in fact going in that direction. All right, going in that direction. And actually, let's change that to 120 days or more. All right, 120 days or more, I think 30 or that makes a little bit more sense. 30 to 90, I'll do the 50. 120 or more, let's go out 30. All right, so let's talk about the two different options that are available to you. That's calls and puts. A call option is a legal right to buy a stock at a predetermined stock price. That is called a call option. All right, and let's see an example here of an opportunity for you to buy a call option. Now, this is AMD, again, one of my favorite stocks that on June 30th, 2017 was going for, this is the, by the way, let me start from the beginning. This is the AMD July 28th, 2017 option. This is a $17 call option. So this was out of the money, right? This was an out of the money call option. It probably had a somewhat low delta, right? But it was trading at the time on June 30th of 2017, not too long ago, right? This option, this July 28th option, was selling for 14 cents a contract. That's 14 cents a contract, or $14, all right? $14 for the option. $14 for the option. Now, as the price rose, so did the value of the option, because I mentioned earlier that options are derivatives. So as you can see here, that skinny line is the option price, and that other key line, right, that darker line that's shaded, is the actual stock, right? Because you got to remember, options are derivatives. So as the price of the underlying rises, the price of the value of the option rises. So here you're seeing the stock going up, the value of the option also goes up. All right, when the value of the stock went down, the value of the option went down. And you were able to get this stock at a very incredible low on June 30th. So what happened was, as that stock cooled off, a lot of people who were smart decided to buy this option because they felt, hey, this stock could probably go back up. And sure enough, the stock did go back up. And as the price rose, so did the value of the option, right? And long beforehand, this option ended up closing on July 12th at a high of almost 73 cents, or $73 a contract. So if you had bought 17 contracts at $14 each, right, that cost you only $238. That's half of your $500 that maybe you have. So for $238, you would have watched the value of your investment go from June 30th to July 12th. You would have seen your investment rise over 400%. So your $238 would have turned into $1,001.98. That, my friends, is why options is a great, opportunity for you to take a little bit of money and turn it into a good steak, ladies and gentlemen. A good steak. All right? Put options. Put options are the right to sell a stock at a predetermined price. So put options go up in value as the value of the underlying or the ETF or stock drops in value. So here we have Snap. This Snap, by the way, is the social media app Snap. This is the Leap option, the January 18th, 2019. So this is an option that is over 500 days away that you can buy today, right now. So On May 9th of 2017, the snap option was available for you to buy, all right, on May 9th at 33 cents or $33 an option, or $33 a contract, excuse me. 33 cents, $33 a contract. All right, but the option itself was 33 cents. All right, so as you can see here, the stock was going up in value. So the put was losing value, right? The put was losing value. But guess what? There are people who say, hey, I don't think Snap, makes much sense. I think the company's got a lot of bad things going on. I want to take this risk here and load up on Snap options, right? I want to load up on Snap options. All right, so this is the $8 put. Now, you can see here, Snap was above $22. Snap was above $22 at this time. So somebody buying this leap option was taking a risk saying, look, it's not going to go to $18 anytime soon, but I think by 2019, we can see this stock at $8. So as the possibility of that increases with the stock going down, the value of the put goes up. The value of the put goes up. And as the price fell, the value of the option rose. And before soon, it was closing on July 12th at 93 cents an option, or $93 a contract. If you had bought 10 contracts, right, back in May at 33 cents or $33 each, you would have paid $330 at that time. You would have seen your investment rise 181% to $597.30 in less than 90 days, with yet a year left on the option. That's incredible. So no time decay, because again, you bought a leap option here. So you had no time decay risk, and you still were able to come up on a bag because you saw the value in this put option. Let's keep it going. Now, in or out of the money. Now, you've got to understand that in the money means that a call's option strike price is below the market price. So let's take, for example, NVIDIA. All right. The NVIDIA July 28, 2017 155 call is trading at $9 or $900 a contract. This option is in the money. Why? Because it's going for $155. That is below the current market price of $160. So if you were to exercise this option right now, you would be in the money. You would be in profit. Out the money means that the call option strike price is above the market price, right? So NVIDIA, again, is at $160. The July 28, 2017 $220 call option is trading at only 14 cents or $14 a contract. This option is out of the money. The market has not priced highly the potential that this stock has of reaching $220. Therefore, this option is very cheap and possibly has a very low delta at this time, because the possibility of it reaching $220 by July 28th is very, very rare. This option is out of the money. All right, now let's go back to options chains. How to read an option change. Now I'm back on ExxonMobil. This option expired today. As you can see here, this is the strike price, right? This is the strike price. This is the agreed upon price you'd like to exercise that option, all right? Or just have the right to exercise that option at. This is the ask. This is what sellers want for their option. This is the bid. This is what buyers want to pay for the option. This is the current change in value. All right. So obviously this is in red. So the stock must have went down or must have barely had went up today. And as I said, I actually put it down here. The stock went up just by a penny. So that's typically not a good thing for people who are buying call options on the day of expiration. You want to see a big move on the expiration day to see a big change in options. And as you can see here, the stock didn't perform very well. So therefore the options lost a lot of time decay, right? So this value is pretty much time decay, eroding at the value of these options, and even close to the money. Even, close to the money or in the money, as you can see here, shaded in the money, options went down. Why? Because the stock didn't really make a move. The stock really did not make a move. And as you see here, these are the calls, again, on the left, puts on the right. Below, this is shaded. These are in the money puts. If you exercise these puts, you'll be in the money. You'll be selling it higher, right? You'll be able to sell those shares higher than what it's going for now. You'll be able to sell those shares higher than it's going for now. Those are the shaded in the money areas. The unshaded areas are out of the money, right? These are out of the money. And as you can see here, out of the money are cheaper because the market has valued that the likelihood of them getting to these prices at expiration are very low. All right. So, and you can see here, volume also dries up the further you get away from the money, especially when you're very close to expiration. You'll see most of the volume very, very close. And by the way, these aren't the most popular options to buy. I'm not putting Exxon on here saying, hey, everybody go buy Exxon options. I'm just using this as an example. All right. These are not very liquid options. As you can see here, the volume isn't very great. All right. Volatility. Volatility is also a very important thing to follow in options, because if volatility is high, the premium on the option will be relatively high. So if you're trying to buy options in a stock that moves very aggressively, I mean $1, $2, $3 a day, or has the possibility to do that, it has very high volatility. And those premiums, right, are going to be very, very high. That's why Nvidia, Alibaba, or Amazon, these have some of the most expensive options out there because they have incredibly high volatility. So you can make or break yourself trading options with very high volatility. They cost a lot, but when they win big. When they lose big. So you've got to be very careful trading options with very, very high volatility. Volume. Volume is probably the most important thing you've got to pay attention to when you talk about trading options. You do not want to buy an option that people are not buying, because when it comes time for you to sell, to get out of that option, out of that right, you want somebody else to come and buy your securities. And guess what? If nobody's there to buy, you're stuck. So just the way you can get stuck in a penny stock and not have anybody to sell to, you can get stuck in an option and not have anybody to close you out or get you out of the trade, especially if you don't plan on exercising that option. All right. So keep in mind that you don't want to just look at the volume of the option. You also want to look at the volume of the underlying. All right. Keep in mind, again, trading volume is relative and needs to be compared to the average daily volume of the stock in question. So you want to trade and buy options in stocks that have very, big volume. SPY, GLD, USO, Bank of America, GDX, which is gold miners, or XLF. Many of these are exchange traded funds, but there are a lot of stocks that have big volume, but also have big volumes on their options as well. Those are the kind of options you want to buy. All right. You want to buy liquid options because you want to be able to get out when things don't go right, and you want to be able to get out when things go right, and you want to be able to get some profit out of there. Now, how do you analyze your options? Well, the same way, technical analysis and fundamental analysis, the same way you analyze your stocks, right? You look at charts, you do your research, either using technical or fundamental analysis. If you don't know what those are, definitely do your research. All right. Now, what are some charts you want to be following if you want to buy options? Now, if you plan on day trading options, right, you holding them either for the day or 1 day or overnight, you need to be looking at the daily chart, the 1 hour, the 10, the 5, and the minute charts. All right. You're basically day trading options. So liquidity is very, very important for you. And so therefore, you don't even want to be messing with any spread larger than maybe 2 cents, honestly. So you want to stick to the SPY. You want to stick to the Qs. You want to stick to those ETFs or stocks that have incredible liquidity, Amazon or whatnot. So you're looking for high volatility and high delta when we're talking about day trading options. For short-term, 30 days or lower, you can look at the daily chart, the 4-hour as well as the 1-hour. All right, so you've got to, kind of look at it from slightly further back, because you don't want to get lost in the sauce of the daily, or minute by minute news. All right, so you want to stand back a little bit. Don't get caught into the noise, especially if you're holding something for 30 days or lower. But again, you don't have to hold it for the whole 30 days. If the underlying makes a big move and you're in profit and you want to take profit, go ahead and take the profit. You do not have to wait the whole exercise time, your 30 days or 14 days or whatever it is you decided to hold. Long term, if you're someone like myself who buys leap options, all right, you're looking at monthly or weekly and daily charts. All right, monthly charts, weekly charts, daily charts. And you're not even really paying attention to the daily up and downs to the news. You're looking at the monthly, the weekly, or daily charts, right? So daily charts even less. Particularly, monthly or weeklies are going to pay the most attention to, because that's where you're going to be able to see the direction of the overall stock in the light of what you're trying to do, which is a long-term option play. All right, now what are some indicators you want to be able to use? Now, indicators, they're lagging and leading. Personally, I like lagging indicators. A lot of people don't. People prefer leading indicators, which are cool. Leading indicators kind of try to give you a hindsight of what might happen. All right. I like lagging indicators because I like to be right. All right. I don't mind missing the first 4 or 5% of a move, as long as I find myself in profit. All right. So I'm all about limiting risk. So if you're a day trader, you're looking at the 4 or 8 exponential moving average. You want to have that on your chart. All right. On those charts that I told you need to be following. If you're looking at a week or higher, you want to have your moving averages on there. You want to have your 10, your 20, your 50. You want to have your crossovers. And by the way, I have a great book on crossover moving averages. Email me at happypennystocks@gmail.com or visit my Discord room. We have that posted up in there. All right. If you're monthly, you got to have your moving averages on there. Okay. All right. You're looking at monthly, looking at holding above 30 days, 60 days, 90 days. You got to have your crossover MAs on there, 10, 20, 100, 200, seeing where the on your screen as well. All right. You want to have on your screen as well. These are great indicators, and there are a lot more. I'm not going to get too deep because I don't want to get lost in the sauce on indicators, but continue to do your best on there. Now, what are some of the best brokers for option trading? Right now, I'm using Tasty Trade. It's $1 per contract. They have no closing cost at all. So if your trade was $10, when it's time to sell, you've already paid. You just simply close the order and you paid your $10. You're in and out. No minimum required. I don't believe there's a minimum required, but to do some things in options, you may need a margin account. All right. So if you just want to buy calls and puts, you can use a cash account. But if you want to, use straddles and all kind of other complicated option strategies, you're going to need a margin account. You're going to be required to put down $2,500 at most brokerage. All right. So I use Tasty Trade, only $1 an option, no other fees included. TD Ameritrade, $6.95 per trade plus 75 cents an option. TD Ameritrade also has no minimum, I believe, needed at TD Ameritrade. $6.95, 75 cents. Now here's the deal on that. That's 100 contracts. That's $6.95 plus 75 cents 100 times, and you're going to pay those two fees twice, right? So when you get in and when you get out. So be very careful. I love Tasty Trade. Options Express is another great place. Option Express, ironically owned by Charles Schwab. They haven't just came together for what I don't know why. But $4.95 per trade, 65 cents an option. Charles Schwab, $4.95, also 65 cents per option. At Charles Schwab, you do need at least $1,000 to open an account there. E-Trade as well, I believe it's $4.95 or maybe $6.95. They also have an option fee. E-Trade is $500 to open up an account there. All right. So I really hope you've enjoyed this presentation. This is just part one. I'd like to get your feedback on what you'd like to see next time as we go a little bit deeper into studying options. I really hope you've enjoyed this. Take the weekend to learn a little bit more. There are a lot of great content and videos that you can go ahead and watch out there. And by the way, I want to just introduce you guys. There's videos that you guys can buy that are available on places like eBay. Gaining Option Leverage by John Nigerian. He's on CNBC. High Impact Option Trading. These are very popular DVDs that are available on eBay for you to buy. 4 Powerful Rules on Successful Option Trading. These aren't available, unfortunately, for download. So don't go crazy and buy a lot of, DVDs and pay a lot of money. Get them for as cheap as possible. I don't pay anything more than $20 for a DVD. So it takes time, and when I see them cheap, I buy them. Because financial education pays itself back time and time again. Let me tell you guys, this stuff has changed my life. All right, it has changed my life. I haven't been big into options up until recently, but the more I do it, the more I enjoy it. The more I do it, the more I enjoy it. And because we're in a bull market, if you try and buy good quality stocks that are running, you can't lose. You can't lose. Press like, leave a comment. Thank you guys so much for watching this entire video. Email me any comments or leave any comments. Donate if you can. I appreciate it because I'd love to make more of this stuff. Until then, take care, everyone. Bye-bye.